There have been a number of excellent conferences in Bermuda recently. I'm sure many of you have attended them. And when the team at the BMA suggested that we had a panel following our keynote speech from John Nelson, quite frankly, I was a little concerned, would we be able to provide something new for you as the audience? However, this was totally dispelled when I saw the lineup of our distinguished panel members who, and I was going to say sit, but perch, I think, is probably better. So I think the rationales for the stalls, guys, is that rather than armchairs where you sort of tend to go back and look very comfortable, the BMA thought we should keep you on your toes. Now, the fact that I have no stool or chair is a little worrying. I think that must mean that they think that I don't have any powers of concentration. So, ladies and gentlemen, I think it's self-evident that this is one of the most authoritative, experienced, and frankly, world-class panels that we've ever had in Bermuda. And it's going to be a great opportunity to hear what they have to say. Clearly, the talent and the experience that they represent on the stage is enormous. I do hear that actually one of the panel members has an additional talent, which is that he wiggles his ears. Dennis Mahoney, for those of you who can't see him. Anyway, thank you, panel, for joining us at this session this morning, and thank you all for my Bermuda colleagues who are here. Particularly, it's such a busy board and renewal time, and as we heard earlier, we had 380 registrants. So anyway, why don't I go ahead and introduce our distinguished panel. So at my far left, we have Andrew Bailey, who's the Deputy Governor at the Bank of England for Prudential Regulation and the CEO of the PRA, a role he assumed in April 2013. He's also a member of the bank's Court of Directors, the PRA Board, the Financial Policy Committee, and the Board of the Financial Conduct Authority. Next, we have Brian Duperreault, a rock star of our insurance industry, I think is how Amanda described you. He's very well known to this audience and is the Chief Executive Officer of Hamilton Insurance Group. He's the former President and Chief Executive Officer of Marsh & McLennan Companies, where he served from 2008 to 2013. And he was previously President, CEO, and Chairman at various times of ACE Limited, and my boss. To his right is Dennis Mahoney. Dennis has worked in the insurance industry for over 40 years, having started at age 3. From 1997 until his retirement in 2009, he held various high-level positions at Aon, including Chairman and CEO of Aon Group Limited and Chairman of Aon Global. He's currently on the board of Ironshore. He was also the past president of the Insurance Institute of London. Dennis did say to me that I was to say that these are all his own views and not attributable to anybody that he's associated with, so I just make that point. Next, we're very pleased to welcome Frank Majors. Frank is the co-founder of Nephila Capital, a leading insurance-linked security fund manager, and is a director of its affiliate, Nephila Advisors. Frank's also director of Nephila Capital and Nephila Holdings. Welcome, Frank. And then another rock star, Mr. Mike McGavick, well-known face to our audience. Mike has been Chief Executive Officer of Excel Group since 2008. He previously, from 2001 to 2005, was the Chairman and President of Safeco. And in 2013, Mike was elected Chair of the Geneva Association, and he will be the outgoing Chair of the Association of Bermuda Insurers and Reinsurers shortly. And he was my boss. And of course, welcome back again, John, a fellow chartered accountant, I might add. Yeah, I am indeed. And as we heard, John was appointed Chairman of Lloyd's in October 2011. So, our panel. So most of you in the audience will be readers of the FT, and their motto is, without fear or favor. So, without fear or favor, for the next 2 hours or so, we're going to debate and, if necessary, debunk some of the issues that are helping to shape the new normal in our industry. The panel will do this via a discussion-based format rather than through a series of presentations. Our aim is to have you, the audience, be a fly on the wall and to eavesdrop on perhaps the end of a dinner conversation between our distinguished guests. Sorry, we don't have the aid of some good red wine. It's too early in the morning. But we'll try and cover as many of the big topics that the industry is facing and try to distinguish between the so-called new normals and the ephemeral new flavor of the month. We'll touch on some of the points that John raised in his opening keynote, and we'll touch on some others. We'll try and examine the drivers of the change as well as the change itself. Depending on how time goes, we may well have Roger hold up a little sign from the audience saying to stop for questions. But if the panel are in good flow, I'll just let them go. So let's get started. Let's talk about alternative capital. It seems appropriate from all the change that we've seen in the industry, it'd be useful to have Frank, given that's his world, give us a sense of how big the ILS market and the alternative market is and how it compares to the traditional insurance and reinsurance. And Frank, I know you would prefer to hear it called efficient capital as opposed to alternative capital. So why don't you kick it off for us?
Okay, thank you. And thank you for including me on the panel today. It's a very straightforward question, Fiona. Unfortunately, I don't really have a straightforward answer. I mean, I think that the question sort of presupposes that there are two separate worlds. There's the alternative world and the traditional world. And if you look at Phil, at least, and a lot of people who have a similar business model, you know, we sell a traditional product. So we manage about $10 billion. Probably $1.5 billion of that is in cat bonds, and the other $8.5 billion is you know, selling traditional reinsurance. So I'm not sure if that would count as $8.5 billion of traditional product or $1.5 billion of alternative product. Obviously, it's $10 billion of alternatively financed activity. So depending on how we define it, you get a different answer. What I would say is that there's roughly about $25 billion, I believe, in the cat bond market outstanding. That's clearly alternative. There is something like $10 billion being managed by reinsurers in alternative vehicles where they are using that capital sourced from a not historically sourced capital base, not equity financed capital base, to support their activities. So I'm not sure if we count that as alternative or traditional, but that's $10 billion. If you look at the funds, there's probably another $5 or $8 billion that's not in cat bonds. So I think the number that most people will arrive at is something like $40 to $50 billion of alternative capital, roughly defined. So I'm sorry I couldn't give you a straightforward answer.
No, but I think it actually talks to the issue. And in fact, my following question, which was for Mike and Brian, was, given that the lines are being blurred, which we clearly heard, has traditional reinsurance effectively been redefined? Or is it just the new normal, and it's part of the world that we're going to continue to experience? Brian.
Yeah, okay. Well, yeah, I agree with Frank about, you know, the roles we play, because there's not much difference, I don't think. You know, I think, to me, an underwriter, or what we do for a living, is matching risk with capital. You know, that's what we do. And most of the time, it's, you know, traditionally, it's standard, you know, stock company, shareholders' equity surplus type capital. But, you know, we've also used the reinsurance market. We were buying cat bonds, you know, 15 years ago at ACE. So matching those two together, and so I just think, you know, the world of insurance today is such that, you know, you don't have pure reinsurers really anymore. You know, so companies have insurance, they have reinsurance, they take risk in, maybe they take it into the insurance piece, maybe they take it in the reinsurance piece. They lay it off some way, and so I just think that if you define yourself that way, then this is just another way of doing your job, and should, if you're doing it right, help you get the best use of the capital that is your own capital, make you more efficient, and give a better product to the market. So I'm not that overly concerned about it, frankly. But if you say, well, this is what I do, I mean, I don't do anything else, and, you know, I'm narrowly focused in this little world of pure re, I think you should worry, but you should have been worried a long time ago. You shouldn't have just woken up to it now.
Mike, any other different things?
Yeah, I'd take from where Brian left off, and then also John Nelson's comments earlier. If we view the world as only the products and solutions existent today, then competition among capital to be the provider is not necessarily all good. It's just entertaining and not necessarily moving the industry forward. However, if we think of it in the frame of the solutions that could be, And if we think of it in the underinsured needs around the world, now we get excited because we really have the kind of capital potential that could match to the needs to advance civilization. That's exciting. That gets me energized. I think two things are really interesting. One is the conversation has shifted rather dramatically in the last half of a year. If you go back a year ago, so distant history, a year ago, it was all of the asset managers were coming to the underwriters and saying, look, you just go over here and do no harm, and I'll take care of the rest. And it was a very one-sided conversation. And in the last few months, it shifted almost entirely to where people remember that the gatherers of risk, which is what we do really through our underwriting, really have a big say in this game, and in fact are the key to the whole process to match risk to capital. So that is a changing dynamic that is very positive because it reminds us that underwriting is still at the center of the art and is still a set of skills that will have value however this comes into the market. That's a big deal. The second big deal is, as is always the case for better or worse, regulation tends to run behind because, of course, the markets are out there inventing things, and then regulation has to see it and say, how does this affect my obligations to the system? And that is interesting. Right now, I don't see that as a huge issue because most of these products are either some kind of standardized product or are collateralized. And as a result, there really isn't the kind of risk that prudential regulators are usually worried about. But clearly, it's going to morph over time if we're going to really fulfill this promise. And that means we're going to have new approaches to regulation in that space that are being talked about but not yet in existence. That, too, I think, is a very interesting dynamic that waits to be played out.
And we'll ask Andrew in a minute, actually, to talk about the regulatory side. But, John?
One thing which I would be very interested in Frank's views on are, I mean, if you look at what is happening, in fact, as we've just heard, the numbers in industry terms, although they're growing, are in absolute terms not that high, still. What I feel, as this is more speaking from my previous background than an insurance background, is that there is now the development of a kind of an asset class requirement from institutions worldwide who want, rather as they did in real estate 30 years ago, they want to create insurance as an asset class. They want to invest it. They think that's in the best interest of their policyholders, their investors. It's uncorrelated, all the good things. Now, the question is, for me, it's a question, do you think that's right, first? Second, do you think, taking exactly Mike's point, that the providers of this capital are beginning to say, look, we're handing it to an asset manager, but actually what we're really concerned about is to make sure that that capital is placed on top of really good quality underwriting so that we know, and that's particularly important if we're going to spread away from the sort of, that narrow section that alternative capital is currently providing, both geographically and in terms of peak risk. So in other words, we're going to need that capital, we know, but somehow we've got to harness it in a way that the investor is, as he gets used to it, gets comfortable that you guys are making sure that they get exposed to the right underwriters. It's really a question for you.
It's a big question. I mean, I think Mike is right. There's risk and there's capital, and somebody needs to perform the function of getting them together. And so I think that the role of expertise is not going to go away. And so expertise can be deployed and financed in a number of different ways, but the core function isn't going to really change, I don't think. Now, I will say that the institutional investors that we deal with, and I know it feels like we're kind of new, but we are, I think, 17 years old, and there's been a real change in the way that investors think. So we have something like 200 institutional investors, and it would probably be unfair to characterize them all as having one voice, but it's really a function of how long they've been in the market. So I think that this idea of catastrophe risk in particular, and that's changing, it's broadening into other classes, but focusing on catastrophe right now because that's what we do, that is definitely being accepted as an asset class by a lot of investors. Now, maybe it's more of a risk premium. I think that most investors think about building a portfolio by collecting risk premium from different sources. and there aren't that many sources of diversified risk premia. So in a lot of ways, it's more like timber or something like that, where it's some sort of obscure risk premium than it is maybe a real asset class. So it sort of gets bunched in as the alternatives, you know. But I think that most investors come in at first, kind of like Mike said, don't do any harm. We can see why there's a structural reason why there should be a risk premium for us. We see why that risk premium makes sense in our portfolio. Don't mess it up, and you know, we'll be fine. And then over time, as they understand more about the market and our company and just get more comfortable with the risk, they start getting a lot more interested in, okay, what value are you adding? You know, what is the expertise? What's the role of the models? You know, and all that sort of stuff. And but our fund structure, we have about $6 billion of our assets. We are paid a fee that's very commensurate with an actively managed portfolio. But you know, about $4 billion of our assets, it's what we call beta funds, where we're basically just saying we will go out and construct a solid portfolio for you, but we're not going to do everything that we do for you that we do for these other people. And so it's not uncommon for investors to come in on the low-paying structure, and then over time want to transfer over to the higher paying structure, which I think is very encouraging for the industry, because they see, as they get more educated, that there's value in expertise.
So Dennis, as we're hearing that obviously the market's evolving, what's the role of the broker, and how do we see their role changing?
The broker's role really, to my mind, hasn't changed. The role of the broker is to get the best possible deal that he can for the client, and that's about capacity, it's about the product, it's about the price, and so forth. And so I think it's fair to say the brokers, Frank, have been very open about encouraging the establishment and the success of the so-called new markets along the way. It raises interesting questions around whether the broker's remuneration is going to be largely affected by the difference between a standard commission, let's say, and a fee in arranging an ILS structure. But one of the interesting things for me is when people say there's too much capacity, because for my clients, my old clients quite often, there was too much capacity for what the underwriters wanted, but not enough capacity for what the client wanted. And it's certainly true, and Mike has made this statement publicly before, you know, we simply don't have the capital capacity for the very biggest risks anyway. Offshore business interruption is a classic one. Contingent business interruption is another in an increasingly connected economy. So we actually need the additional capital, both for the increased complexities and the sheer size of the operation. But it does mean there are going to be changes for everybody, including the brokers, insurance and reinsurance brokers along the way.
Let me ask you another question. Cat bonds, there are a number of disputes on the various cat bonds. I mean, there's a lot of cat bonds in the marketplace. Is that just the normal maturing of a product, or is there a question mark over the efficacy of it?
I think there's 6 outstanding right now. There's major disputes going on, but I think that's normal in the order of things. We don't have any disputes in the insurance industry for standard products. Please, I mean, really. And so, you know, it's bound to happen. You know, we've had parametric triggers, we've now got mixtures, we've got indemnity and so forth going on. Eventually, I think that it will be accepted that there's a more standard way of dealing with some of these issues, and I don't see that as a major blocker to the future. Let me tell you what it's like when you're a broker and you have to go to the client and say, well, you know that great insurance company I put you with? It's now in runoff. And guess what? I've got to go and try and collect the claims, and it isn't going to be easy. Okay? And I've put up with that for 40 years, so you know, it's an issue, but I don't think it should be a game stopper, personally.
Yep. Go.
I was just going to ask Andrew a question here. If you, the point I made earlier about, in a sense, the danger of some of the structures that may come into play in terms of, you know, inverted pyramids or whatever, which happened in the banking sector, is that, and looking at the stability, basically, that the industry provides the customers, is that something that the PRA look at, are concerned about?
Yes, it is, because it's consistent with our 2 objectives, which are safety and soundness of insurers and protection of policyholders. I mean, I think that the observation I would make to start with is that it's a view I hold very firmly, is that it is no part of a regulator's role to prevent entry into an industry. So the fact that there is capital coming into the industry is not something that we should, in a sense, you know, react adversely to. Moreover, putting my sort of central banker's hat on for a moment, it seems to me this point that was made about the emergence of insurance as an asset class is quite logical, actually, which is, in a world of persistent, very low interest rates, and a world, and I say this offering no view on anybody's monetary policy, including the UK's, where there's a strong argument that actually my colleague Ben Broadbent has put forward, which is that interest rates on average are going to remain lower for the foreseeable future. The emergence of alternative asset classes is actually entirely logical in that world, and that's what we're seeing happen. So all of that, I think, as a regulator, we say, that's what's happening, and it's no part of our job to prevent that happening. The emphasis then, as you say quite rightly, John, is to say, well, one of the things we're concerned about, we're absolutely concerned about underwriting standards. I think Mike's point is absolutely right there. And we're obviously also concerned about the robustness of the management of risk and the spreading of risk, which is obviously where the particular reinsurance point comes in. So those should be the points of our focus to ensure that, let's say, given that we've got new capital coming in, to which we should have no objection, don't have an objection, that the process maintains the prudential standards that we expect. And I think that's where we fit in. Final thing I would say is it does seem to me also to make the point about the growth and capacity that in a world where there is a growing demand for insurance globally, we shouldn't really be that surprised that capital's coming into the industry.
Yeah, it came in a bit early.
Well, that's a matter of judgment.
So, John, let me ask a slightly cheeky question.
Yes.
Bermuda has emerged as the centre of alternative capital.
Yes.
Did we steal a bit of a march on London and Lloyd's?
I think Bermuda is an incredibly healthy, vibrant insurance market. If you look back in history, and I wasn't in the industry then, but I'm just I'm repeating what most people in this room already know, the speed with which, and I give the BMA quite a lot of credit, because the speed with which markets reacted to events, lack of capacity elsewhere, was a very good symptom. You grabbed a lot of market share 10 and more years ago, 10, 20 years ago. And I think alternative capital is in some ways a very good example. But I think in a funny sort of way, I wouldn't make too geographic a point about alternative capital, because alternative capital, bluntly, is global. It's in the ether. So it's just a question of who does it rather than where it's done. I wouldn't put it in those terms.
So when the Boston group came up with one of those recommendations, which is embracing alternative capital, is that a broader London market issue?
Yes, well, it is in the sense that if you could say, yes, Bermuda, in your terms, might steal a march, but I think if I look ahead, curiously, I think London, and particularly Lloyd's, is in an extraordinary position, because being the only market in the world, we've got a ready-made ecosystem where we could attract capital, as it were, into the Lloyd's market, not necessarily within Lloyd's itself, but allied to Lloyd's, to provide that facility for our managing agents and therefore the insureds. And I think that would be quite attractive both to fund managers and to investors. And that's something which we're looking at very carefully. However, what we have to be extremely careful about is that we get, for the reasons I was saying earlier, we get the structures right. Because what we don't want to do is to set something off which actually destabilizes the whole bit of pajang.
I agree very strongly with Chairman Nelson's comments there, and I probably would have been a little bit cheeky in my response had I been he. He's much more polite than I am. I think I might have said, well, actually, we stole the march by 300 plus years. When I look at
very good.
With no disrespect to BMA, I don't have a dog in this fight, at all, so I don't want to be controversial, but when we look at Lloyd's, we see really their core function has been for a long time bringing risk and capital together. So going back to their very history. So I agree and share the excitement for the future for Lloyd's as having a very central role in this process.
Great. Well, I think we've talked about alternative capital. We've talked about regulators' response to that capital. If there's not any more thoughts, I thought maybe we could go. Frank wants to say something else.
One more comment. One thing, and I think Mike's comments were exactly spot on, that this sort of development of alternative capital does have the possibility for concern or abuse or misuse or being taken too far in the future. Right now, I think that I just would like to make the point that the effect of the alternative capital is to actually de-lever the industry significantly. So it's a very different, right now in this stage of the development, very different from like the mortgage securitization, which was a process of adding leverage. What it really is taking a risk off of levered balance sheets onto unlevered balance sheets. And also, I think that if we think about alternative capital not as a group of new people showing up at the party, and think of it as a technological advancement of what it really is, which is channels to more pools of capital. If you have access to deeper pools of capital, that should add stability unless it's abused some way. And so that hasn't happened yet. It will. It'll be a good idea that will be taken too far, and we need to be vigilant against that. But right now, it not only delevers and therefore includes the claims paying of the whole process for an event, but it also helps the stability of the system, because post-event there are more ways to access capital. And I don't want to make this a moral or ethical thing, so I won't use the term disgraceful, but it's certainly, I think, embarrassing as an insurance or reinsurance professional, the industry's inability to respond with any sort of price consistency post-event. If you look at 2006, very dramatic spike in rates for a lot of reasons that were outside of the control of reinsurers, rating changes, model changes and so forth, but certainly the inability and the lack of the technology to access a broader pool of capital certainly exacerbated that. So I think that to the extent that not only claims paying ability for the current storm, but being able to provide capital the day after the storm, I think this is a very positive event.
Mike?
I think there are two things that actually I'm going to comment on that one too, but there are two things from the earlier conversation that are really worthy of note. One, let's be very clear about where the risk lay, because I think, as you say, the likelihood of it evolving to something less stable or abusive is real, and the thing we really ought to all be thinking about, because that drives to the heart of trust in the system, and we don't need distrust in our system. And where that comes is where there's a disconnect between the ultimate holder of the risk and where the risk was understood and placed. And the more that adds leverage distance, it has great opportunity for there to be new clashes in exposure that are unrecognized, and when they come due are unpayable. That, in essence, is the story of the real estate crisis, and that is the risk here, because the risk is being removed from those that took the risk. The advantage of the integrated model is you're betting with your money. That changes how you feel about it. And there is a risk, if you redefine this and lever it back, that you'll have too much distance and new risks that will come into the game. So that's what we got to keep in mind, what it is we're afraid could happen. That's not all bad, but if it's done the wrong way, we've seen what happens. Recent history. Second is, let's talk about what holds us back. We keep talking about this great opportunity, and the point was made by Dennis very well. That's right. For the things that we know well and have comfort with, there's too much capital. For things we don't understand and can't get our heads around, there's too little capital, for obvious reasons. And while I'm as much of a champion for innovation in the sector as anybody, it does need to be insurable risk. And we need to keep our wits about us as we develop these new products. The heart of why there's been so much capital flooding into the cat space is somehow the models have tipped over to being trustworthy. Now, those of us who are deeply in the industry kind of smirk a bit at that. All models are fallible, and there's nothing about cat models that say that they're perfect. The recency effect we've seen too many times. So I get very nervous about the level of trust in the cat models. That's where we are, right? But it's how do we get new categories of trusted risk? That's where the great opportunity is and where the great mind share has to go. And it won't start with big bangs. It will start with little tests, and it'll grow into something meaningful. But we've got to get on that journey in a more authoritative way. In terms of cyclicality, though, one more point. Look, one thing about insurance. I can guarantee every time there is more capital than there is available risk, we will skeeter off into inadequate pricing. It will happen every time. It's a combination of human optimism and the fact that we are the only industry we know of where we don't know the costs of goods sold. We just don't know. And we will screw up, go over cliffs, and need to recover. That we recover imperfectly is the fact that from time to time the industry will be forced to recognize a simple fact. We will make mistakes, and some of them will be big, and we will remember that in the risk business there is always an unknown, and sometimes it's really big.
Brian.
And we lose the risk premium all the time.
Brian.
Just a couple comments. One, Andrew said there's growing demand out there, and certainly logical that you'd have an alternative where insurance becomes an asset class. And yet when you look at where it's located, it's in the reinsurance business, and there's a declining demand, right? Our buyers are buying less. So that's kind of an interesting, how'd that happen, problem. The alternative capital, the ILS market in particular, has gravitated to the big bang cat, right? The reasons for that, rates online match nicely with interest rates and non-correlation and everything. If it breaks out of that, and one would assume over time that happens, it gets into a messier area of the insurance business, right? It gets into a messier area where you're going to have, it's not as simple. An event happened, reinsurance pays quickly. It's not going to be as easy to break out into that area, and it's still reinsurance. And so the real question for alternative capital is how does it get into the mainstream world of insurance, and how does it get into insurance as opposed to reinsurance? And that's the real question.
Let's take one more comment on alternative, and we'll move on to a couple more themes, just because I think the audience will probably be interested in a couple more areas.
I want to touch on what Mike said about cyclicality. It's so important. We sold our clients on continuity and stability, particularly in London and Lloyd's. And so the big question amongst a lot of my clients is this new capital here for the longer term? Or if there's a big increase in interest rates, or they see something else as an alternative, will they migrate? And I'm not making a comment on whether I think they will or won't, but it's a very big question, because if you're the CEO of a major corporation making long-term investments in capital and buildings and so forth, you need to know that if you're going to rely on the insurance industry, it needs to be there. It needs to be there for the long haul. And that's why I think Mike's point is so right about looking at that longer-term effect of the additional capital coming in.
And hence the point that we were talking about earlier of keeping, and it's going to be a continuous challenge, and I'm looking at Frank a bit here, that as the alternative capital market develops, the temptation to detach the risk from the capital becomes ever greater. And there will be kinds of securities where the returns look really alluring. But if we do that, we will destabilize the whole thing, exactly as happened in the subprime mortgage market in the States. And I'm looking at Andrew there. Right.
So she's lost control after 45 minutes. That's great. That's okay. Now, I would like us, I think this has been fascinating, clearly about opportunity and what new capital looks like. But I'd like to talk to us about how efficient or indeed inefficient we are as an industry. When you look around us, every aspect of our lives have been changed by technology. Every aspect, whether it's how we buy online or whether how we, personal lines is delivered by the internet. And although we talk extensively about getting our act together around technology, the fact of the matter is this industry is not known at all for either being able to corral or adapt that technology to make us more efficient. So, one of the things I really want to ask the panel, but let's start with you, Brian, because you and I had a chat about this in terms of your investors and their use of technology. If we don't do it for ourselves, don't we run the risk that somebody else will come and do it to us?
I think it's night follows day. That's the reality. Every other industry. You think of all the other industries out there that have been touched by technology, and I'm involved on a board of a company that is in the fire security business, and they think of themselves more as a software company, and so it's in mainstream industries they think of technology differently. It's transforming them. It'll transform us. So you look at the the average expense ratio for the, say the U.S. market, it's in the 30s, right? It's in the 30s, right? And if you look at it, about 2/3 of that's distribution and 1/3 is internal, something like that, in that range. And so does it make sense for us that we deliver our product, which should be relatively straightforward? Maybe we don't make it so straightforward, but it's a relatively straightforward product, that it would take 1/3 of the dollars. And when you actually look at the dollar value, I mean, the amount of money, per transaction, very, very high. So I think it's natural. Now, for a lot of reasons, we move incrementally. Some would say glacially in our attempt to change ourselves, right? Regulation stops some of it, right? Legacy problems. I always point out you have passive resistant employees that don't want to do this either, right? And so it's not, the chances that we ourselves reform ourselves, I think, is low. And that's why I think an external force coming in could be quite disruptive. But you still have to deal with the wonderful world of regulation. So it won't be so easy, but I think it has to happen. It has to happen. I mean, I think it's, you used the word embarrassing. I think it's embarrassing for us to deliver our product the way we do. And John pointed out Lloyd's. Lloyd's is higher than the others in its distribution. So it isn't just the insurance companies that have to do something about this, right? The producer, the broker, the agent out there may be more inefficient.
Yeah. Can I make it's very interesting, actually. I make an observation. I regulate 2 industries. I thought I'd come here with a sort of cardinal principle of not saying the word bank in this panel, so I'm going to break that rather early on, obviously. So I regulate banks and I regulate insurers. And I say this, by the way, let me also add the preface's comment that in saying this, I do not in any sense wish to deflect you from modernizing the industry. But if you said to me, which one of these 2 industries is more fleet-footed and is more able to adapt its product quickly, it's not the banks, who, by my experience, are a long way behind. And that's quite interesting. I mean, I'll give you an example. I mean, probably the most extreme case of this in the UK markets we regulate is UK motor insurance. I mean, this thing is, it's slightly anarchic, this market is. But nobody can say it lacks competition. I mean, there may be some imperfections around the competition, I should say that. But so it's quite interesting. I mean, so I don't want to deflect you at all, but it's quite interesting that as an observer of 2 industries, one is more efficient at innovating.
Well, maybe that's a comfort.
Yeah, I mean, I think from where I come from other industries, ignoring banking for a moment, I'm not so much talking about the retail insurance industry, I'm talking about the wholesale B2B specialist industry, the kind of business that Lloyd's is in. I would have to say it was one of the most stark things I felt when I first came in. This is archaic, what we're doing. It really is. And it's going to hold the industry back. And is actually a potential threat to the long-term sustainability of the market as it is. And my own feeling is I look at other industries I've been in, be it telecoms, retail, even banking, actually, in some respects. I do think we're behind. And the interesting thing was, when I first came in, everyone would say to me, Lloyd, well, it doesn't actually matter. It really doesn't matter. And what is interesting, I mean, I took an opposite view, that actually it really does matter, because if we don't improve end-to-end processing, really improve it, we will become, it's not so much, it is partly a cost issue, but it's not just a cost issue, it's user-friendliness. If we are trying to create the markets in the emerging growth territories, if we're not easy to deal with, we won't get the business. And it's very interesting, in the last, I would say just the last 18 months, the tune has completely changed in the London market, and people now see the imperative of getting on with this, and therefore we are now beginning to see the results. And as many of you will know who've been in the London market, this has been a discussion going on for more than 10 years.
40 years?
Yeah, and I really feel that now we're on the way, and we need to be.
But if I can just pull your tail for a moment, John.
Go on,
Obviously
yeah, please do.
I like pulling the tails of chairmen of organisations I regulate. I mean, to what extent is that change of mindset a product of the perception of greater competition?
In large part.
Yeah.
In large part, exactly the point.
Dennis, I know, is chomping at the bit because this is his favourite
I had thick
topic.
black curly hair when I started out on this crusade. And you couldn't tell if my ears were moving at that point. But I want to ask everybody a question. Put your hand up if you've actually been to London and Lime Street recently. Fairly recently. Let's say the last couple of years. OK. How many of you saw hundreds of people running around with paper files around Lime Street in London?
Yeah.
Thank you.
Exactly.
Now, back in '97, Marsh, Willis and Aon got together and they created something together called WIN, the World Insurance Network. I was very privileged to serve as the chairman of the World Insurance Network when this started. And we said, we're not trying to automate the business, guys and gals, we're trying to change the way we do business. Change the way we do business. And we worked at it, and we worked at it, and we worked at it, and we got nowhere. We took a group of underwriters to Brussels to see SWIFT, which is the banking system for processing what we call fiduciary funds, premiums and claims. And everybody said, isn't that wonderful? And we did nothing. WIN was absorbed into Accord, which is the global body that defines standards. I still sit on that board today because I want to keep at it until they pour earth on my grave. And when I read the most recent report, sir, I thought, I've seen this before. And I think you and I had that conversation, didn't we? Fiona?
Yes.
Déjà vu. And the part of the reason I'm here, by the way, in Bermuda, and I love Bermuda, it's a fabulous place, it's my home, is because I made a speech in 2011 at which I got exiled by the brokers, in which I said,
That's why you're here?
That's why I'm here. No tax, no, yeah, anyway, no mother-in-law, ex-mother-in-law.
Now totally out of control.
No, the point I want to make is this. Does anybody believe that premiums and claims should throw through an intermediary today? Or is the technology there, God help us, for when the deal is consummated by the broker of the box, premium goes straight to the client, principal to principal. And I don't care whether you use Ping or Apple Pay or any other system, but we could be able to do that, right? Simple. And what about the number of disputes we have around degradation of information? Why can't the information flow directly from buyer to seller? No more arguments about who said what to whom. Simple technology we've had for years and years and years. You have no idea of the resistance that we all ran into, the senior officers of Aon, Marsh and Willis, in trying to introduce that.
Not when I was.
Not when you were there, no, that's true. But my fellow brokers saying, well, we have to do it because it's so complicated. Do you know how complicated state taxes are? What? State taxes? Who cares? We can send rockets to the moon. State taxes, right? But I want to be serious about it. There is an issue for the brokers, remember, because if we switch that tomorrow, which I'm sure Mike would agree is a great idea, and Frank and so on, they've got legacy issues in terms of processing premiums and claims going back 30 and 40 years. For those of you that follow the professional press, you'll see that we're still getting new asbestos claims and reserves. Agreed? And the brokers are still handling the in and out of all of that, the premiums, the claims and so on and so forth. So whatever we do, Chairman, we have to take into account that whilst we would agree, I'm sure all of us, with what I've just said, you're going to have to take into account the legacy issue for the brokers in that process.
Sure.
Yeah, and just take the information flow that we require, the application process, and what small business person wants to fill in that app? Nobody does that, right? So they give it to the agent makes up some stuff, right? So it gets in. So the quality of data from the beginning is a mess, and yet we have a wonderful world of data out there that we could know more about the client, even maybe than the client knows themselves. We can certainly determine they really do own warehouses that they didn't declare and all the other stuff that it's there to be done. It will get done. There's no question about it. It's just so inefficient given what we can do today technologically.
Mike.
Having come to the industry late in life, I've always been shocked by all of the waste. It's just absolutely astonishing. So I've wound up, and particularly because Safeco was really all about, modeled underwriting and lowering platform costs, I've really been deeply involved in some of these really big reinvention efforts. And I've come to appreciate a couple of things that make me less optimistic that we'll get this done for Dennis to enjoy.
In my lifetime, we're running
Much though we owe it for that ear entertainment. But number one, a big part of what is going on in driving these additional costs that you could argue someone will reinvent out of the way is a trust premium. Because we are making a promise to be there to do something in the future around what could be disputable events, the trust premium is huge. This is why the broking system has so much influence on the process. This is why how those legacy systems operate is so crucial, because they establish rules that must be met long in the future. And much of the cost and much of the legacy system frustration that the industry experiences relates to that central element. And curing for that is really hard, is really, really hard. So as easy as it is to sit on your porch with the moon coming over Bermuda and rail at it that we haven't solved this yet, it is desperately hard, costs a huge amount of money in a product with very thin and thinning margins. And the reality that we're going to wake up, snap our fingers, and fix it is nonsense. It ain't going to happen. Because of that, insurers and brokers compete with each other on the basis of efficiency. That's healthy in the sense it drives the market toward greater efficiency, but it is terribly inefficient in those categories of waste that are about common solutions like WINS or Accord. Those were common solutions to blocks of the cost that really have no reason to be seen as competitive advantage opportunities. They should just be solved so that we can compete on the real things like product and so on. But the reality is, until someone comes up with a magic bucket of money that costs none of us any margin and says, we'll solve that for you, we're going to continue to compete on that stuff. And that's the reality.
Mike, while you're in a roll, I'm not sure if you heard all of John's speech, but one of the things he touched on was the London Market Group study that has been prepared by the Boston Consulting Group, and indeed late-breaking news that the Chancellor's autumn statement yesterday talked about the fact there's going to be this task force formed to look at how to make the UK and London in particular more, I guess, competitive, whether it's regulatory, tax, efficiency. You're going to step down as the head of ABIR. Do you think that Bermuda needs a view like that, where we have a collective market view, where we make ourselves more productive, competitive, given that clearly the UK is going to be doing it?
Yeah, well, as usual, the English are following the Irish. The Irish announced such a study a couple of weeks ago. I think there is something really important and deep in these topics, really, really important. And it actually goes to some of the challenges I see on the horizon, and not all good challenges. The effort to re-regulate and I know we'll talk about regulation more separately, but the effort to re-regulate the industry in light of the bankers' failure has been a very, very interesting and intense experience. Some of it very good, some of it not. The reality is, if you step all the way back, all geographies, I don't care whether, and I don't care what jurisdiction you're talking about. You could be talking about states in the US, you could be talking about counties in Ireland, I don't care what you talk about. All jurisdictions at some level are in competition for two things: financial and intellectual capital. The more a society has of it, the more advantages it has, the more opportunities for their children to work forward, and the more opportunity for them to help the world. And the less they have of it, they become beggars to the international community. So the notion that this isn't a competition going on is a fool's game. It is, and it will always be, or at least I certainly know it'll be till dirt is thrown in my coffin. That's just a reality of human evolution as the part we're living. These jurisdictions are in competition. And the notion that somehow there's going to be a magic wand waved and they will all unilaterally come to the exact same approach to regulation and tax and governance at the same moment in time, who thinks that'll happen? This is a joke. So the question then becomes, how do they compete in a way that, given the global nature of business activity, doesn't create instability and barriers to entry for those who would improve the system through competition. That's the great game afoot. Bermuda, I would say, has a huge stake in this competition. I will admit, there are times when I have watched, and of course, we may be an Irish company, but we were born here and helped develop what happened here, and we still have a huge stake in what happens here. We care a lot. And the reality is, we have to view this through a competitive lens. It may be a friendly competitive lens, but it is a competitive lens. We want more of that. If you're Bermuda, you want more of that intellectual and financial capital here. That's just a reality. And it is a market, John. This is another of the world's great insurance markets with different specialisms from some point than London. I sometimes worry that as I look at what's going on, we see a game between the haves, the very large, very industrialized nations with very expensive governing structures and very high tax rates. We see a game where the haves would just as soon drive the have-nots out of the game. I believe that would lead to a weaker world. More centers of capital and talent is inherently stabilizing, fewer is inherently destabilizing. Common rules and models are inherently destabilizing, multiple approaches are inherently stabilizing. And I'm hopeful that Bermuda will take on the challenge. I hope Singapore takes on the challenge. I hope someone in Africa takes on the challenge, become the centers for their geography with their own great pools of intellect and capital and approach. And that's how competition should work, and that'll lead to a more stable world. And that would mean to me that Bermuda should certainly take on that as a challenge.
Why don't we take one last comment from John, and I'll open it up then to the audience.
I would entirely agree with Mike on that. I mean, I think it's very important that different centres do develop. And if you look, speaking for Lloyd's, and I know what you say, that Bermuda is a market, but it's in a sense, Lloyd's is the only physical market with subscription market in the world. But we have certainly taken the view that we want to develop Lloyd's globally in terms of hubs in centres cross-continent. And I think that is healthy for the industry, it's healthy for the customers, for the insureds, and it's healthy also for actually increasing the penetration in terms of the underinsurance, the penetration of insurance in those developed countries. And if you look at, for example, the work that Singapore is doing in accelerating that in Southeast Asia, it's absolutely palpable. And it's very important that that happens. And as you say, it is unrealistic to think that we're going to have a completely level playing field. So there is a competition going on, and there are some things that we can do, speaking parochially for London. If we look at, we'll come on to regulation, if we look at, for example, the impact that the British government had by lowering corporation tax, it's been significant for the UK insurance industry and the impact of direct investment into insurance in the UK. So that is good, and other countries, no doubt, will be looking at that.
Okay, any questions from the floor of our panel so far? Dinos.
Dinos Giordano, Arch Capital. I'm going to go back to the efficiency question and challenge my colleagues up on including a representative from the regulatory system. But isn't a business model that creates lack of innovation? The broker is there to provide advice. How good the promise are you buying? And I will facilitate that promise to be made good in sometime in the future. That's the promise. But that client never knows the cost of that activity because we all embedded into the product. Here is an insurance policy. You're going to pay X amount of premium, and it all embedded in there. In my experience, any business model that it embeds things without everybody understanding the cost of what they're buying is a formula for maintaining the status quo. What if our regulators say, no, from now on, we're going to change, and there is a cost for the promise, and it's a direct payment by the client to the provider, the risk taker, and there is also a direct payment from the client for the promise. So,
Brian.
Can I just say something, Dinos? It's an interesting point. So 2 things. One, I had great discussions with sophisticated insurance buyers about whether they paid the broker or the carrier did. I mean, think about that. These are Fortune 500 types, right? So that's point number 1. Point number 2 is when we had at Marsh McLennan, you know, the great problem with contingent commissions, we were under an agreement with New York State and many others that we had to disclose the commissions. And we went through this process where we would say to the buyer, and this would be small buyers or large buyers, right? Because we had all kinds of risks. And we'd say, okay, now I want you to know that we will get 20% commission for this product. That's before you sign up, okay? Then they would sign up. Then we said, okay, we're going to go to market. We want you to make sure, did you remember that you paying us 20%? Yes, okay? Then we would place it. Then we'd say, by the way, we placed it and we got 20%. Then we were required halfway through the year to say, by the way, just wanted you to know, halfway through, and we got 20% commission. No buyer ever objected. We never had a single, like, that's way too much. Or what's that for? You know? So I do think, back to the first question, I mean, the first statement, and then this, there is a misunderstanding what that all means, you know? And I think maybe, you know, some way where it's actually directly paid, something like that might make sense. Because right now, all the disclosure in the world, it's still a mystery, even to the biggest buyers. It is.
Dennis.
It comes down, Dinos is absolutely right, the definition of value, which is why I was making the point about is process value. Mike quite rightly says this is very difficult, it's a big issue, quite right. My argument is, well, if we don't start to deal with it, and we haven't, in my view, made a start. But I think that there is potentially a discussion with the brokers about the pot of money that Mike talks about, because actually they don't know the cost of goods sold, the point you made earlier, Mike, any more than the carrier does, because the claims come up from 25, 30 years ago, and they've made no provision to handle them. But if one said to the brokers, look, we're going to take you out of process entirely, make it easier for you to define to the client the value you're adding. Program design, program placement, knowledge of the market, innovation, all the things that I believe are true value added for the client, separated away from the process. But they don't know. I would sit at board meetings there as chairman of London operations, and my CFO would say, here's the amount of investment income we've made this month from fiduciary funds. Perfectly legal, those are the terms of trade. And I would say, how many thousands of people have we got in the back offices in Romford, in London, in India, processing all of this stuff? And the answer was we didn't know. We still don't know today. And so I entirely agree with Mike that it's a huge issue, but we really do have to do that. And it comes right to the heart of your point about separating the duality or the dichotomy. Am I the agent of the buyer or the seller? And I really do think it's about time we address that issue.
Now, if there's not any more questions from the floor, and since this is a BMA panel, I think we should talk about regulation. I hate to do that, guys.
We don't have to.
It's all very straightforward. You know.
Andrew, what does good supervision really look like from a regulator's perspective?
Well, it's interesting you use the word supervision. So the words regulation and supervision get used accidentally and interchangeably quite often, and it's sometimes I think we're on this side, our side of the fence are as guilty as that as anybody else, actually. I mean, they are quite distinct activities. You know, regulation is the sort of the framework of rules, and supervision is how you do it and how you put them into effect. So sticking to supervision, and I'm really pleased you asked that question, not what does good regulation, although you probably asked that question next, which quite recently actually. Good supervision for me is founded on a close and continuous dialogue, which runs up and down our institution and the regulated firms. And by that I mean, you know, through the levels of seniority. If I'm honest with you, in the UK, the system ran into trouble in the period leading up to the crisis, because I think the The dialogue was fairly broken in places. It wasn't happening at all levels. It wasn't happening at a senior level. And that's not because I, and indeed, senior people in the firms, somehow have a monopoly of wisdom. I mean, I'm all too painfully aware that I don't anyway. But because being able to explain why we're doing things, being able to explain the problems that you run into, as I always say, in the PRA, one of our sort of absolutely central principles is that we are a judgment-based supervisor, which is done against a framework of rules. It has to be against a framework of rules because there has to be predictability, there has to be legal certainty. But then we are applying judgment because we have to be forward-looking. I always say it's really nice to know what your capital position was yesterday. It's quite useful because it's a sort of starting point for having the discussion. But what we're all interested in is what are the risks to your business coming in the future. So I really would emphasize in answer to this question the quality of the dialogue and the openness of that dialogue. To me, it's absolutely at the heart of it.
Well, I'd say good regulation shouldn't be you can't fail, right? Because I think that stifles, limits the ability, to deliver a product at a good cost to the customer. So I think good regulation has to allow for, within this group, failure, right? So you have to be able to handle failure, but not say there should be no failures. We can never have an insurance company fail. I think, in its essence, the regulators, I think the good regulators keep the bad players, the bad actors out of the business and allow the good actors to get on with what they do, and that's encouraging innovation, delivering product, and I think keeping the bad out is maybe the most essential element of what they do, because if you can do that, then you really have an efficient professional market.
I mean, there's a survey which says for most CEOs, regulation is the thing that's number one on their list of concerns. And I guess the question is, do we end up with strategic paralysis, lack of innovation? I mean, somebody anecdotally told me this week that a major reinsurer in Switzerland had submitted 100,000 pages of documentation to support their internal model to a regulator.
Yeah, I think if I could say, I think Solvency II I would put into a different compartment for these purposes. Because I think maybe we should come on to that, but I think it's a very big, but the
more like a black hole.
yeah, black hole, yeah, $500 million for us. But in terms of the rest of regulation, I mean, I totally agree with what Andrew says, that I think the important thing is very close dialogue, communication, so that for the regulated things and the supervised, it's predictable. You know what's coming, you know what the concerns are all the time. And I feel that very much as being chairman of Lloyd's, that I hope we do have a very close and continuous relationship. I know at any one time what the concerns are. Hopefully they know what we're doing about it and so on. Equally though, I think that the trap, I would say, that the UK fell into, I'm getting my years wrong, probably 5 years ago, was that, this is pre-PRAs, that the FSA, and partly in response to the banking crisis, 2007, were regulating right down in the weeds. Every single little thing was being regulated and supervised, and they were losing the macro picture of any particular organization. And I think something which good regulation, good supervision does, which I certainly think Andrew has brought to the PRA, and indeed you see it in other regulators, is a very close examination of what really is important, what matters, what are the macro issues, and focus on those and test those. And I think that is something which is being much better done, I feel.
Mike, we have to touch on Solvency II. I know at the Geneva Association you had some thoughts.
Well, I think it's been interesting. Solvency II starts from a number of really good and essential principles. It starts from a notion that the fewer conflicting regulatory schemes there are, the more likelihood there is for efficient and comprehensive regulation. That's a good starting point. It starts from the point of view that there needs to be greater harmonization across the world in order to create greater trust against different regulated entities. That too is a good principle. And it starts from the notion that, that capital is a dynamic, and therefore you have to have models that are inherently dynamic to understand the effective solvency of organizations. All of those are advances in thinking about regulation. The trouble has been, from 2 points of view. Number one, the approach of the Europeans to the rest of the world, I think, I don't know if they would admit it yet, but I still think they got off to a bad start. There was heard around the world a bit of an arrogant notion, you shall be equivalent with us. Well, who named you guys? I mean, the Americans looked at it and said, we have the largest and most successful insurance system in the world, go jump. And we've been going backwards since. I mean, we have, and this has created a lot of threat. That was the close moment. Yeah, it's not. And that's really a problem because really harmony across the various approaches in the U.S. and it would be a huge step forward. Huge step forward. The Chinese have already said we're kind of going our own way. The Brazilians have their own protectionist. I mean, we're seeing a number of bad fallouts, and I think that was all kind of a wrong-footed start. And I don't know how to fix that. The second is that Solvency II was evolving at a time when you suddenly had this great financial crisis that taught us all that, you know, not only are very complex systems risky, but also that, that regulatory failure happens too. And because clearly that was a failure across the piece, from the institutions engaged in the products to the regulators and the gaps that were created across various products. And as you think about all of that, Solvency II wound up with this huge wind in its sails right at a time when I thought it needed more reflection. So it became the de facto advance of insurance regulation. And I now see signs, worrisome signs, that the development following on, whether on SIFI regulation or on international capital standards, feels a little bit like an endgame to get Solvency II established as a global standard, which I think would be foolish. No one model should be the standard. So I continue to hope that the bright spots we saw in the beginning and that gave rise to much support for Solvency II are fulfilled. That equivalence means comparable and not identical, that there really is equivalence granted, for example, to Bermuda, which deserves it. I mean, there's a number of key tests to me that are near to hand, and then whether international capital standards become a proxy to give the Europeans back their level playing field, having now created a standard that is much more demanding than the rest of the world, or whether we allow different flavors to flourish and let competition go where it may. I think those will be the really interesting questions to hand, and certainly whether at the Geneva Association, I know the great work ABIR does, AIA in the US, all those institutions are working hard to try and get to a good landing from what I think has been a pretty contentious process.
Can I comment on that? I mean, I couldn't agree more with this, actually. I think that the idea that Solvency II is a means to export a European standard to the world is just flawed. It's not going to happen. I mean, it's not going to happen. And the reason I think this is very important is the work that the IAIS is doing, and frankly is being encouraged to do by the FSB, is crucial here because, so I know that it's not, it's not had a massively positive reception. I can understand why, but I think trying to use that to get a sensible answer on equivalence. And that sensible answer on equivalence might take a number of forms. It might be a capital standard. It might be an equivalent standard which, you know, comes in one form or another. Would be, I think, a huge benefit. And I think it would be a way to head off what I think would be a bad outcome if the answer is the world should have Solvency II.
Everybody agrees that regulators should be working more closely together and cooperating. Why is it elusive? I mean, is it because everybody's so focused on what we're having to do at home?
Well, I think there's two If I may, I think there's two things that really stick out. You know, I have wound up spending an inordinate amount of time. I keep leaving the room at the wrong moment. And when you do that, you wind up chairman, and don't do it. The thing that I think about is that, and an example of a step backwards, and you know, I'm talking about a lot of friends here and a lot of people with a lot of influence over Excel, so you have to say these things very carefully. But for IAS to actually reduce the amount of input it's taking at this particular moment in time was a very strange and unhelpful decision. They made the decision to really limit and restrict the number of interlocutors that could be had in their development of ICS process. And while they would argue they're just trying to manage an unruly circus, which is no doubt true, that really wasn't a moment forward for transparency and the ability for us to really deeply share. And even if it's more symbolic than practical, which I think is fair for them to say, that was the wrong symbol at the wrong time, that we're going to listen less right at the moment when we're about to make absolutely critical decisions. And this idea of internationally active insurance groups dealing with international capital standards, IAIGs and ICS, you know, these are some letters we in Bermuda really better get to know, because by definition, just about everybody here is one of those. And this will be a capital standard that we're going to have to live with in some fashion, and it's being developed in great haste, great haste compared, you know, I always look at the banking standards, right? Basel came in after the failure of a bank in Germany in '74. The first capital standard was adopted in '88. They got that one wrong. They did another one a dozen years later. They got that one wrong. They're doing another one now. We think we're going to create one whole from start to finish in, you know, kind of 2 years. That feels rushed for an industry that is doing fairly well. Were we in crisis, I might argue speed would be good. Being not in crisis, I would first think of the advice to first do no harm.
But I think to your point about international harmonization, if you think about it, it's not really realistic. If you think about China, Singapore, India, South America, Brazil, UK, Brussels, United States, do we really think it's practical to get complete harmonization? No, it isn't. No. So we have to live with that.
We do. One of the things that I read, Andrew, that you had discussed was the concept of orderly failure. And the issue to me is, how do you make that work? And is it an oxymoron for the uninitiated? Can you have orderly failure? And how do you make it work if you don't have the cooperation? Because, you know, quite frankly, it's highly likely where there is one that's significant or systemically significant, it's going to be cross borders. So how does orderly failure work?
Right, well, the good news is that if I say this, there'll be nothing left for me to say at lunchtime, so you can have a longer
sorry.
lunch. But no, it's okay. You're right to focus on the largest. I don't think there's an issue with the smaller ones. I mean, it's an interesting statistic that a third of the insurers that we regulate are in runoff. So I don't, so clearly that model works. I think with the largest, yes, there are issues, and it is right, therefore, to focus on those issues, but it is right to focus on them as unique issues in the context of insurance, not to sort of plug in a model which, by the way, we haven't actually managed to work out in banking yet. We're just sort of having another go at it and hoping that we might have found something. And one of the key differences, I think, in that world is that most of the major banks of the world, not quite all, would have to be resolved on a unitary firm basis, because their activities are so interconnected that the idea of taking them apart and saying you've got sort of discrete pieces that you can deal with separately isn't feasible. And in the banking world, it tends to be called single point of entry resolution. Instinctively, I don't think that's the case with insurance. And so, it's critically important when we look at this question that we look at them as, as different businesses with probably different solutions, actually, and that's appropriate. Can I just, while I've got the floor, just respond on the IAIS? Two things. This may not be very popular. I think, first of all, the IAIS, as it was not really, frankly, hitting the mark. Something needed to be done to make the institution, or needs to be done to make the institution more effective. But that's something can't be distancing it from the industry in ways that actually mean that the conclusions that it comes to don't reflect a sensible interaction with the industry. That's a route to a bad outcome. I fully agree. The other thing I would say is that I think the speed at which whatever this solution is to this capital standards / equivalence question that we've been discussing, I think within reason, speed is less the issue, I agree. I mean, and the issue is, can we find a sensible outcome to this issue? So it's got onto the table quite rapidly. How long it needs to stay on the table to get a sensible outcome, I think, should be an open question.
Well, we probably run the risk that we might steal all your thunder from your
That's
speech.
right.
So why don't we just move on to talk a little bit about market conditions and the interest rate environment. But if there are any questions on regulation, this is a great group of people who've got vested interest in regulation.
Again, Brad Kading again. So this morning started with a conference call of insurance associations from Europe, North America, and Asia, all focused on insurance capital standards at the IS. And the common denominator position is that the local jurisdictional capital standard had to survive, and that the ICS measure could be applied as the notional measure at a lower level to provide some benchmarking and to establish some parameters around which jurisdictional capital standards had to meet. But the idea of replacing jurisdictional capital standards was a non-starter with the Asians and the North Americans and the Europeans on this call. So, Andrew, how's that match with the world of possibility and the IAS?
Well, I would say we should be open to good ideas. So I would encourage you to put the idea on the table. I'm not saying, therefore, it will be necessarily the outcome, because we need to have the debate, but I think we should be open to good ideas. I mean, I think the point you make about harmonising regional standards or harmonising national standards is well understood. By the way, there's also pretty difficult questions on accounting standards as well, obviously, that underpin that. And the goal, as you say, is to establish an acceptable degree of equivalence, I think. So how you get there, I think, good ideas should be put on the table. And I'm saying, I'm not going to say any more than that at this stage, because this is still early days.
Dennis.
Just looking at it from the client standpoint and listening to this situation, which is complex and difficult and so forth, what do they do? Answer: fall back on the rating agencies. If he's got an A rating, fine, you guys can use them. If not, then we're not going to use them. And I use that as an example because, Mike may remember this, there was a very famous Irish insurance company that the big brokers were all being harassed by to use, and we said, no, we will not use you, you do not pass our standards, we don't care what other standards you pass, and thank God we didn't, because they collapsed with a huge crash to the ground. But the reality is that in the absence of any sort of agreement, all that the client and the customer can do is fall back on the rating agencies.
So let's talk about the,
it's a question about, what are we trying to achieve with the capital standards? So there's harmonization, that's one thing, it's so standardization, or at least comparability. But, is the capital standard also to be so high no one can fail? That's a question, right? And, I remember when Solvency II was first being, sold to us as an idea, it was, and I think the English system and the US system did allow failures. But the European system basically at the time was not one that allowed failures. So the capital requirements are very, very, very high in Europe. And I think it was, as I remember, the initial reasons for Solvency II coming to the fore was to give Europeans a means of being competitive with other jurisdictions in terms of capital, and therefore allowing, companies to fail. And so they said, and so the promise was, we'd look at your internal models, and we'd recognize the differences in what you do, and so we won't try to have this one thing fit all of you. So it'll be bespoke. Right? And so, fine, that's great. Then along comes 08, and no one should ever fail again. Banking now, but banking then becomes financial institutions. We're one of them. We can't fail. And all of a sudden, to me, the fear I have is we continue to go down this road of well, we can't have insurance companies fail, so you have to have more capital. And if it's equivalent, the highest standard wins, and all of a sudden we're in a world of excessive capital relative to the risk we're taking.
And there's that is a fear. The IAS has been has expressed a very good goal that as colleges are evolving, that the reason for an ICS is a way to talk across those local jurisdictions and give meaning to each other's system so we could understand their trustworthiness. That's a very good goal. If that was really all we were going to do at this stage, I think that'd be really healthy. I think the reason that I think sometimes when I'm interacting with some of my friends in the regulatory community, I do have one maybe or two, but they're always a little surprised by the urgency with which we come at this. Yeah. And I'll give you a really simple mental framework. In re-regulating the banks, which, you know, who would disagree that needed to happen? You're playing with companies that going into the crisis were operating with 20+ ROEs. 20+ ROEs. And fairly efficient costs of capital given the systems that were underpinning it, okay? When you come to us, you're dealing with an industry that as a whole both has a high cost of capital, kind of 9s, 10s, 11s, depending on what Frank Kier's next, but 9s, 10s to 11s, right? And with margins that are right about there on an average historical basis. We generally are right around cost of capital. As a whole, there's outperformers and underperformers. As a whole, we're on a knife's edge with capital. We see all of this social need in underinsurance. We have more we've got to get to do. And we're living on a knife's edge of margin as an industry. And we're talking about requiring more capital or increasing the cost of capital. That's why it's such an urgent conversation, is we don't have 10 points to give back. It isn't there. For us to remain attractive to capital, not only do business models have to reform, but we have to be able to invent new things to afford the investments we've talked about on systems, on new product. When you add all that together, that's why there's so much urgency, because we see it as a possible constraint to providing our purpose in society at the exact time when we got stress tested just like everybody else in 08 and 09, and we passed well. So you kind of get frustrated.
It's very interesting, actually, to make one point here about Solvency II. And this is where it gets, there are differences within Europe. So we, in the UK, are migrating from a UK capital regime that was put in place, you know, early years of, well, following the failure of Equitable Life, actually. So it was in the sort of, you know, mid-period of the last decade, to Solvency II. The work that we've done, you know, a lot of work, and it's very, very much a live issue for us. The work that we're doing does not indicate that Solvency II leads to higher capital requirements from where we start from. It will change them, so I'm very keen to stress that we're not just trying to engineer this to produce the same result, because, you know, that's not the case. But on average, and actually just not on average, actually really across the board, sorry, I should say, it doesn't produce high. That's our view at the moment. Now, quite a bit of the rest of Europe is not starting from that point. It's starting from a pure Solvency I point. Our regime in the UK is Solvency I plus what we call a Pillar 2 add-on, which was to say the post-Equitable Life regime in which we introduced models. But most of the rest of Europe, I think I'm right in saying, is starting from a pure Solvency I point. So it's a much older regime. And although I haven't seen their numbers properly, I think you do in that world get higher capital requirements because you're starting from a different place, I think.
As we listen, sorry.
I mean, it is a major concern. I mean, we've had many dialogues on this for us, that what we're concerned about with Solvency II, there are still some extraordinary anomalies in Solvency II, which are, to my mind, unacceptable. So, for example, you are penalised for being prudent in terms of currency hedging, which is completely bizarre, but that's the way it is. So there's still a lot of work to do, in my view, in getting some more sense into parts of it. And secondly, I do think, I hear what Andrew says, but we are nervous that there is still a sort of a mindset in the regulators, not just in the PRA, of saying, well, look, Solvency II is throwing this out, but actually we just want to load it a bit more.
Yeah.
And whether Andrew and I have had conversations, we'll have more conversation about it. I'm just nervous about that. And while I think it's a European thing, it's an equivalence thing for Bermuda, we have got to make sure that everybody is interpreting on the same basis. Otherwise, on this area, there needs to be harmonization of those who are under Solvency II. Otherwise, we're going to produce some extraordinary anomalies, which will massively damage particular institutions unfairly and unnecessarily. And that's a real concern that we have.
So given that it sounds as though it's likely to be more capital than less capital, what does that do for our marketplace? You know, this is a challenging environment already in terms of returns. Do we think we're going to see some more consolidation? We've seen a little bit in Bermuda just recently. Do we think there's more going to happen? Brian, I know you're on the acquisition trail.
Little things.
Little things, but that's okay. So any comments on the state of the marketplace in terms of, is Bermuda going to look differently in 24 months? Is London going to look different in 24 months?
I mean, I think a lot depends on the evolution of the market. If you paint a really challenging picture and it actually comes to pass over the next 3 or 4 years, to think that there won't be some consolidation, I think, would be naive. I think there will be. I think inevitably there will be some, there always is some consolidation in a market like Lloyd's, which is made up of medium, relatively small managing agents. So there's always M&A activity going on. I think that will continue. You can see it, just in the last year. But in terms of the broader picture, will there be major M&A transactions? I would look at Brian and Mike for views on that.
But he's sitting over there.
Yeah. But
well, let's bring Frank from an interest rate environment point of view, and we definitely won't ask Andrew to comment on any level of interest rates. But from your business, there's an argument which says actually a change in interest rates from the capital providers is a bigger issue than a loss event. Do you see it that way?
I mean, frankly, no.
No.
I worry about a lot of things. That really isn't one of them. I think the story is that when interest rates go up, that investors will leave insurance risk to find yield other places. And I just, frankly, the short answer is I think it's preposterous, to be completely frank. The long answer is, when we started in the Philly, short-term interest rates were 7%. Not that we raised a ton of money out of the gates, but obviously the basic concept was not based on yield. It was based on diversification. And I think diversification is incredibly powerful. And I think it's becoming more and more valuable to investors as the globe gets more intertwined. It's harder to find. And its value was demonstrated very recently and very painfully to a lot of investors who thought they had diversification, but actually they had diversification in good times, but they didn't have it in bad times. And so I really don't think that's an issue. I mean, on the margin, is it easier to raise money right now because there's yield? I mean, absolutely. There's no question. But, we say that investors come in for the opportunity, whether it's a hard market or yield or whatever, but they stay for the diversification. And the other thing I would say, just fundamentally, when interest rates go up, the return to our investors does go up as well. It's a floating rate investment, so they get a risk spread over whatever interest rates are. So if interest rates go up 5%, their yield goes up 5% as well. So, I don't want to dismiss it as a complete non-issue over like our growth and our industry's growth over the last 3 to 5 years. It's certainly been a nice tailwind. But to me, it's again, I frame it in terms of technological advancement. I mean, the use of email doesn't depend on the price of stamps, is the analogy that I use. And I don't think that interest rates are going to drive the use of this what I view as a new technology for financing one very small part of the insurance landscape.
Let me just comment on the acquisition question, because I think he asked me to give you an answer. So, I used to say, like, when everything is going wrong, merge. I mean, that's the way to get out of it. Get something. So you'll have to explain what was wrong, you know, so I get this new bright thing that I'm going to do. But I think if you look at the, you know, why didn't we see more mergers in the last, you know, several years? I mean, because you know, you would have expected more consolidation maybe than actually occurred. A couple of things. I think one, the returns weren't bad. I mean, so the cat business wasn't bad for a long time, you know, still not bad. But I think there was no compelling need. Buyers were still buying reasonable amounts of coverage. And also the book values were not necessarily in the greatest shape. So, you know, you're not going to sell, if you're trading below book, you're not that interested in selling your company for still below book, right? So I think the book valuations were an issue. But I think today, you know, companies looking at the competitive landscape say, I think I've got to have some balance to what I'm doing. I need some diversification, right? If I'm doing property cat, maybe I have to do casualty. If I'm doing insurance, I think maybe if I'm doing reinsurance, I think I better have some insurance. And so I think the activity out there will probably be to fill in and balance out and not be so dependent, because the property cat business was a wonderful business, but now because of rate changes, not so much. You have to think about what I do with this capital. You look for diversification. I think that's what's going to be the motivator.
Yeah. We've heard lots of topics this morning, you know, whether it be efficient capital, whether it be technology, efficiency. We haven't touched a lot on people, and given that people are at the very heart of this business, one of the things I wanted to talk to you all about really was change is just part of the world that we're living in, and accelerated change is just part of the world we live in. But how do you bed a culture within all of your organization that really breeds the ability to adapt quickly? Anybody like to have a stab?
I'll try one version.
Sure.
You know, we at, certainly at Excel, but I would say whether it was the London market or the Bermuda market, you're talking about institutions and environments that have been adapting and have been about innovation and change for a long time. That's certainly what we would view as our calling card. We were born in a crisis to solve problems, and we've been doing it ever since. So I think there is an embedded culture that organizations like this and markets like this are blessed with. The challenge is to keep that fresh and to think of it in the frame, how do you get the best talent on your side? And that's the great challenge, because creating organizations that are large enough and complex enough to make a real difference and not fall prey to the bureaucracy that almost always comes along and makes that not such a great place to work is the great challenge. You want to be big enough to make a difference and still have an environment where people can be entrepreneurial, can be creative, and can do outstanding work. And as long as that's the culture you're trying to encourage, inculcate, and grow, you're all right. If somehow you've allowed bureaucracy to creep in there and muck it up, you're going to have a big problem.
Yeah.
I mean, obviously at Lloyd's, it's a sort of whole different, we're not running a business, it's a market. I think one of the things I've been really impressed with when I first came into Lloyd's and subsequently is the culture in the insurance industry. If I compare it with other unmentionable parts of the financial services industry, there is a good culture. There is a good culture of trust. There's a good culture, I think, of innovation, and I think professionalism as well. There are some issues which we've been talking about, like technology and so on, but I think it is something which we really need as an industry, and I'm talking not just London, but globally. We really need to hang on to this because it's very important. Now, part of it, I think, is driven, frankly, by the fact that and I will now mention the bankers, the problem the bankers have is that they keep on trying to change their culture. But every time they do, then the body politic wants to go back to the old days. And that, frankly, is partly to do, I think, largely to do with remuneration and structure of remuneration, whether you like it or not. And the insurance industry somehow has managed to keep a reasonable, I'm sure we're not perfect, but a reasonable balance of reward, where we're not rewarding insurers as providers of capital, which is what's happening in the banking industry, when of course they're not. We certainly do reward capital when it's provided in the insurance industry. We need to keep that, and that culture sort of feeds in. Now, in terms of Lloyd's, I think the challenge for the market is, one, to keep up this spirit, which Mike was talking about, of innovation, excitement. And then in some ways it's easier because we're a collection of relatively small businesses. So we should be able to do that. And we've got to be very careful we don't snuff that out with excessive regulation ourselves in terms of managing the underwriting process. But the second challenge, I think, is we've got to embrace much more nationality diversity into Lloyd's, particularly into the underwriting market, because the qualities and the talents that we see in places like China, Brazil, Mexico, Turkey are extraordinary, and we really need to embrace that, and that will do a lot of good to not just to our market, but to the industry, and will also, I think, accelerate insurance penetration. And taking the point that Mike is making, we've really got to get onto the front foot in terms of getting into these markets and getting the penetration up.
Okay, Roger's just given me a little bit of a nod saying how much time we've got left. So what I'm going to do now is I'm going to close on a seasonal and prosaic note. I want you to tell me what's on your holiday wish list this year. What present would you most like, now it can either be for you and your company or for the industry, to receive on December 25th? And here's the nub, nobody can have the same answer, so you have to come up with different answers. And in order that I aren't told that I'm asking favorites, I'm going to take your names out of a hat. So while you're thinking about what you most want for Christmas, I'm just going to tell you a little story. And I think a couple of you gentlemen in the room will know this story, but I'll tell it anyway. One December, very, very long time ago, a British ambassador in Washington was called by an American radio station, and they asked him what he'd like for Christmas. He said that as a servant of his country, he absolutely couldn't possibly accept a personal gift, but the journalist persisted. And eventually the ambassador, anxious no doubt to get back to whatever ambassadors do, said, well, all right then, I won't wish to cause offence, perhaps just a very small box of crystallised fruit. Now for us English people, that's what people do give at Christmas. And he forgot all about it until Christmas Day. And he turned on the radio and he heard the announcer say, and on this holiday morning, with the new year just a few days away, we call the representatives of 3 great nations to find out what they'd like for Christmas. First, we asked the German ambassador, and he said he'd like to see the final resolution of the East-West conflict and a long unbroken world of peace. Then we asked the French ambassadress what she would like, and she said she'd like to see the elimination of crime and corruption from our society so that the youth of the world could march without fear into the future. And then the announcer said, we asked the British ambassador what he would like for Christmas, and he said, a small box of crystallised fruit. So, ladies and gentlemen, no crystallised fruit, but hopefully that has given you a moment to think about what it is that you would like. So, Frank, what would you like for Christmas?
Well, I guess I would like to find a way to deliver capital more efficiently to the problem that we're focused on, which is catastrophe risk. I mean, when we look at that distribution chain, we talked a little bit about technology. That certainly plays a part, but there are a lot of links in that chain, which I think makes it a little bit more difficult for the consumers and the businesses on the ground to access capital. If you look at a typical condominium in Miami, there's an agent that goes to a wholesale broker, that goes to an MGA, that goes to an insurance company, that might go to Lloyd's through a broker that then, is financed through buying reinsurance. That seems like a fairly inefficient chain that could be easily improved upon. So that's what we're hoping to achieve.
That's what you're hoping for.
Yeah.
Andrew, what would you like for Christmas?
Well, I mean, obviously your story actually really illustrates that the British never lose their sense of humour. Because British ambassadors are ultimately urbane and, I'm going to have two goes. Of course, I want us to implement Solvency II and then work out what we do with it. No, seriously. So let me then try a French or a German answer. I mean, I do think, and sadly, of course, as we've said this, I'm afraid the banks have a lot of responsibility here. I think getting to a world where there is an understanding of what the finance industry does for society, an understanding that going right back to John's comments in his speech and the discussion that actually free trade and free trade in financial services is actually crucial to the world economy. That's in insurance and in banking. And I worry about the rise, I do worry about in all these sectors about the rise of fragmentation and protectionism. So to be absolutely serious in the sort of big picture sense of the word, working, and this is going to be a hard slog, working to a world where we have a greater understanding of the role that finance provides in society, and that we can lean against tendencies towards fragmentation and protectionism is a big thing.
Great. Dennis?
This will be supported by members of the audience, including Dinos, Brian O'Hara, Joe Rigo and Brian. I like and need golf lessons.
I agree.
Mike?
I'll take it. This is an insurance answer, but I'm going to start somewhere different. I'd like a year very different from last year. Two things happened in this world that I don't think have been paid attention to enough, and they have to do with whether we'll be presented with risks that we can insure or can't. In this last year, we saw society knowingly use chemical weapons against its own people and face no sanction from the international community. And in this past year, we saw a territory of one sovereign nation be taken by another. The first of those we had banned at the end of World War I. The second we thought we'd solved with the end of World War II. So the two greatest mechanized killing sessions in human history's main outcomes were undermined last year. 2011 was a year where disasters popped up that gave us rise to new opportunities for insurance. That was a year that should whet our appetite to solve more problems. This past year gave us examples of issues that we can't help with and that are much more threatening. So I want a year very different from last year.
Sobering thoughts. Brian?
Oh. I thought I was going to win that lottery and come in last, so thank you. Well, if you had asked me 2 days ago, I would have said
the America's
Cup, I'm wearing a little pill pin right there. So I got to come up with a new one, huh? Mm-hmm. And so I can't, I'm going
America's
past after Mike. I mean, after that.
I know.
So I think I might go with the British ambassador on this one.
Right.
I have, or your golf lessons. We've just signed to acquire a company called Sports Cover, and we are now in the wonderful world of approval by the regulators. And it would be wonderful if on Christmas Day I opened that box and you gentlemen had said yes. So
And John,
he could say yes, it wouldn't matter. It's the other. It's
but not on Christmas Day. I'm not doing this on Christmas Day.
And John, I hate to do this to you. We asked you to open our session today, and now I'm asking you to close it. But
right.
What would you like for Christmas?
Well, I'm going to abuse the fact I've come last, and I'm going to ask for two presents. The first present, funnily enough, is the sort of the serious one, which is following up on Andrew. It's not the same as Andrew, but it's sort of taking the crystallized fruit principle out of greater trade liberalization. It would be wonderful, and I think it would send a message to the world if India passed the insurance amendment bill. And they've got a chance to do it. And I think that would have all sorts of ripple arguments. It would allow all of us, I think, and it's very important that we do, to get the message out about the benefits of liberalisation, particularly in the insurance sector. And the second present I would like very much is, and I haven't quite worked out how to do it, but I'd like Frank to design me a derivative which actually meant that in some way Sir Ben Ainslie wins the America's Cup in 2020.
So, ladies and gentlemen, I'm sure you'd agree with me. We could probably go on for hours, but I know Jeremy has to come up and speak, and I don't want to get on the wrong side of him. And then Mr. Catlin will be introducing Andrew Bailey, and I don't want to get on the wrong side of Mr. Catlin either. So please join with me for our appreciation for the panel this morning.